Welcome to Bendigo Bank's market update for December, with our latest thoughts and reflections on the outlook for global markets and the domestic economy. In our last update for the year, we'll look at the RBA rates on hold decision and where to from here, the likely drivers of the economy next year, and the global backdrop, including the US and their latest interest rate cut. The RBA kept our official cash rate unchanged at 3.6% this week, as universally expected, and warned us that recent inflation data leaves no scope for further rate cuts until if and when price pressures moderate, but also stated that rate hikes aren't out of the question. The recent jump in core inflation up to 3.3% in the first complete monthly CPI series was another setback for those looking for lower interest rates, with broad-based price pressures, but particularly high inflation for housing, travel and accommodation. Some of these factors may prove to be temporary. However, the RBA will want to see clear evidence of this over the next 6 months before being tempted to adjust policy from current levels. The market has quickly moved from pricing in one more rate cut next year to now pricing in 2 hikes in 2026. And while the possibility that the easing cycle is over is clearly much more likely after recent data, the proposition that the RBA may need to hike rates early next year does seem very premature. At the start of this year, here in our market updates, we forecast 3 main predictions for 2025. A shallow RBA easing cycle to around 3.5%, a recovery in household disposable income and spending thanks to these rate cuts and lower inflation, and a resulting pickup in private sector demand. And having seen the first 2 of these, the latest GDP data for Q3 did appear to verify the third prediction, with private demand leading the contributions to growth through private investment and household consumption. Growth for the quarter was held back a little by net trade and drawdowns in inventories, but the economy is growing at just over 2% year on year. So with real GDP growing at trend, a pickup in business capital expenditure, and unemployment still relatively low in the mid-4s, the case for further RBA policy support is tenuous. While it's pleasing that these forecasts from the start of the year were achieved, it's important to note that offshore factors did threaten these outcomes during the year, especially with the aggressive US tariffs unveiled in April, which did encourage deeper cuts to our initial forecasts mid-year. But the resilience of our economy and our major trading partners to tariffs and trade tensions has been one of the highlights of the second half of the year, and explains why cuts below 3.5% are no longer needed. As such, the most likely outcome now for the RBA next year is no change at all, as was the case in 2024. But if the RBA do need to adjust cash rates next year, I'd suggest a cut is still just as likely as a hike. After all, global markets are not completely out of the woods. The US is still cutting their rates with weaker labour markets, and as the chart shows, the previous record shallowest peak-to-trough RBA easing cycle is 2%. So just 3 cuts into this cycle, suggestions that the RBA will be hiking rates early next year do appear hasty. In 2026, we do expect the recent surge in business investment to continue, currently led by capex in data centres, and for the private sector to continue to drive economic growth, helped by resilient export markets, although our forecasts do continue to point to a higher unemployment rate. In short, the current AI investment boom is likely to steadily transition to a productivity and output boom, which, over time, will probably lead to higher interest rates. But as we've outlined on our Business Insights website throughout this year, that tightening cycle is more likely in 2027 and 28. Nevertheless, the growth outlook is promising for 2026, and Australia's labour markets have been the star performer amongst our economic peers. And that's the market update from Bendigo Bank, with best wishes for a safe and peaceful holiday season.